Hey everyone, and today I would like to address a frequently asked question that we've gotten quite a bit here as the markets are in a little bit of a tailspin, it seems, as a result of the coronavirus. So the question is, should I sell stocks now and buy them back later when the coast is clear? And that seems like a pretty straightforward and simple solution. We all have this what can I do now response. And I just kind of wanted to address the practicality of that and just think that through. So bear with me. It's in this presentation is kind of in a narrative format. And I wanted to, but at the end, I'm kind of going to show really a graphical representation of this. But assume for a moment that investor A has recently absorbed about a 30% decline in her stock mutual fund as follows. So on December 31st, she owned 500 shares of a great stock mutual fund, and the total position was worth about $50,000 or $100 a share. So on April 1st, after a significant market decline, that same 500 shares was worth only about $35,000. That represents right at a 30% decline in this particular investment. So what she decides is to kind of sit out on the sidelines until the coast is clear. So she's going to sell her 500 shares and collect her $35,000 in cash, preserve what she has, and kind of wait until the storm clouds clear, the coronavirus passes, whatever the problem of the day happens to be. She's going to sit it out and wait until the coast is clear. So it turns out that it's a really good decision. You know, at the point where she sold, since that point, the markets have continued to decline. They've declined another 10%, 15%, whatever happens. And so it looks like a great decision. If she hadn't sold her 500 shares, she would only have about 31,500 after this 10% or more subsequent decline. So it looks like a great decision. Now, finally, on July 1st, several months after her original sale, it seems like the market has stabilized and started a little bit of a recovery. She then decides to invest her $35,000 back into the same exact fund that she owned before. However, the problem is that the market has appreciated. So the news seems good, the coast is clear, and so now her $35,000 only buys her about 438 shares of the same fund, which before she had about 500 shares. So she's picking up those shares at about $80 a share. So nevertheless, the coast is clear. She's feeling pretty good about that decision. She preserved what she had. Now in September, new economic data comes out, and it seems like the recovery has really stalled. And this investment now declines back to $65 a share. This is kind of a common scenario because lots of the economic data is lagging. And so as the economic data comes out, there's always this, oh gosh, the second shoe is going to drop. And so there's always going to be that fear out there. So now, unfortunately, her total investment is only worth about $28,400 after this, precipitous $15 per share decline. If she had maintained her original 500 shares, she would have still had about $32,500. So plus any dividends that she would have received in the meantime. So companies are still paying out dividends, and you would have still received that. So you can tell there's a little bit of a disparity from that, what seemed like a great action to the actual reality of this scenario. And this particular person has actually absorbed the same decline on two separate occasions. I cannot stress this enough. This is something that people overlook. Once you buy, the only way you can accomplish this strategy is to buy in at a lower point than what you sold, and that is highly unlikely for a person who is fearful and scared and all those emotions that we have. They're not going to then come back and buy in at a lower point than where they sold. So this particular investor has absorbed the same decline on two separate occasions. Just a terrible move. This is kind of a graphical representation here. You can kind of see the end of the year, this person had 500 500 shares at a price of $100 a share, $50,000. You can see in the 1st of April, late March, the share price of that investment has dropped to 70. So that's the 30% decline. Investor A decides to sell, collect her $35,000 and stay on the sidelines. You can kind of see here that over this course of time, she has maintained this position of 35,000. Meanwhile, the share price has continued to decline. And wow, look at this. I mean, it was down to $63 a share at the very bottom, it seems. So it looks like, wow, this is a great thing to do, this ripping the Band-Aid off and kind of go into the preservation mode and sticking with cash. But what happens here is at $80 a share, the coast is clear. The media is saying, oh, the coronavirus we've got it under control. The threat of further spread has subsided. We've got this huge stimulus package that's coming down the pipe. All of these things are positive, and the market recovers as a result of that. This particular investment recovers as a result of that. So this investor decides to invest her $35,000, but now at $80 a share, she can only buy about 438 shares. So bottom line is, at the end of the day, if the decline happens again, there's a huge difference in the ending value. So, and this is kind of a typical scenario. This happened in the 2008. This happened in the tech bubble back in the early 2000s. This is kind of a typical scenario. You just can't sell and then buy back when the coast is clear. It just doesn't make sense. You can tell here that over the long history of time, markets have rewarded discipline. There's all of these negative times that have happened: Y2K, 9/11, the subprime mortgage and Great Recession. All of those things have happened. But ultimately, at the end of the day, the markets recover, things look better, and things get better. So what should you do now? First thing, do not panic. There's no need to panic. You have a long time horizon. Trust and stick to your financial plan. What does that mean? Accumulators and pre-retirees, continue saving and investing, rebalance your portfolio. This is likely to be, while it's a challenging period of time to go through, I think that as we look back 10 years from now, we'll all look back and say, man, I wish I'd invested more. I wish I'd stuck to my guns. I wish I hadn't been so worried and made productive decisions. Retirees, depend on your conservative bucket for distributions and rebalance as you need to. So keep in mind, as a retiree, you should have some money set aside in a conservative bucket. I know for Beacon's clients, we have a diversified compilation of bonds, cash, short-term bonds, lots of different things that hold relatively steady during this period of turmoil. And so depend on that bucket and use those funds to cover your living expenses. Also, revisit your financial plan to consider if adjustments are warranted. What does that mean? Well, scrutinize your cash flow. Are there some discretionary expenses that may perhaps need to be cut just because we don't know how long it might take for this recovery to happen? That's just the kind of thing you just need to reassess, look at your cash flow. Are there any things to cut? Does it make sense to scale back a little bit, at least temporarily? After that, feel free to give us a call if you have any questions. I hope this has been a helpful video. 919-803-3801. Have a great day.